Good morning, everybody. Thank you very much for joining us today. I'm really excited to introduce our guest presenter and talk about our topic. Before we do so, let me introduce myself. My name is Jim Codney. For those of you who are new to our webinars or new to Western Marketing, I'm the National Sales Director here. So thank you very much for taking some time out of what probably is a very busy schedule to participate in this webinar. A couple quick things. First of all, we know we wouldn't be here without you. And when you're here sitting on a webinar, you aren't out at appointments, paying bills, putting food on the table. So we promise to, as much as we can, give you just really good information and get you out and back to your business as quick as possible. With that said, we hope to provoke some conversation in our webinars. So if you have questions, please type them into the question box. We typically get to those at the end of the presentation. With that said, if you ask something specific about a case that I'm not sure if that's going to benefit the whole audience, but it's a valid question, don't fret. We will follow up with you on a one-on-one basis after the webinar is over. So ask any, relevant question and we'll get to it. So our number here, if you have questions, is 800-852-7152. Again, 800-852-7152. And so without further ado, I'm gonna say it's my pleasure to introduce somebody who's not only a business partner, but has become a friend and frankly is the person that I go to. So if you ever reach out to me on life insurance and I don't know the answer, Brad Weber with Brokers International is who I call, email, text, bother every day. He's a business development consultant. So basically, he helps us out with anything we don't know. So he's going to go over a case study on IUL products today. So with that, Brad, welcome. Thanks for joining.
Thank you, Jim. I appreciate that introduction and appreciate everyone joining the call today. We are going to talk a little bit more involved on index universal life products. Again, my name is Brad Weber, business development consultant at Brokers International, and I specialize on the life insurance side here at Brokers. Our disclaimer, this insurance and financial professional training is provided as a general source of information. These are hypothetical examples just to provide to you some ideas or some opportunities to potentially engage with your clients. We are not providing tax or legal advice. If you do have a scenario that involves that, you would want to utilize a tax advisor. So we'll start off with just some general questions here. I'm sure you're already aware of and know how to engage your own clients, but just some other things to think about when you are sitting down in front of a client or having a conversation with a new client. First thing we like to do, or we would encourage for you to do, is to ask them if they have any sort of existing coverage. And if they do, that doesn't necessarily mean that has to be the end of the conversation. If they have existing coverage, life insurance has transformed quite a bit over the years. Maybe there is an opportunity to still work with that client to potentially find them a solution that might be a better fit, utilizing their current insurance, potentially converting that into a newer product. You may ask them just simply, do they have any protection against their liabilities in the event of a death? Do they have life insurance or something in place to help protect so that they're not leaving their beneficiaries with those liabilities when they pass away? Do they have a plan to provide financial protection to their loved ones in the event of a death? So life insurance can be used as a very liquid asset, even for those individuals, and we'll talk about this a little bit more later on here, even for those individuals who seem to have a large number of assets, is there potentially a way to help protect those assets, or maybe their assets are tied up in other things that are not liquid, to be able to utilize life insurance as a liquid asset upon the death of the insured? And then I imagine a lot of you are probably working with business owners. If you are, potentially asking them if they have a plan to transfer their business upon their death, or potentially even at retirement, other scenarios, disability maybe even, that may warrant a transfer of the business. Do they have a plan in place for who is going to be the owner of that business going forward, whether it's another generation within their family, or potentially having another organization purchase that business? So just some ideas, some things to think about. And then we'll take a look at some case studies here. I've got a few different scenarios. The first one is a protection IUL case. So as many of you probably already know, an index universal life can take a couple different forms. This first scenario we're going to look at is related to a protection index universal life policy. So we have Jack, who's 48, Diane, who's 46. They've been married for 20 years, and they have 2 children. Jack, in this particular situation, is the primary income earner. He does have a nice 401k as his employer, and feels like he's in a good spot when it comes to his future and being able to retire. Diane's busy with the kids and their schedule. She does work part-time, helping supplement some of that household income, but she does not have a retirement account like Jack does. Now they have about $50,000 left on the mortgage and some other small debts. So we could potentially look at a protection index universal life policy. And there's different ways that we can design the protection IUL policies. There are protection index universal life policies that have what we would call a guaranteed rider associated with them. So a lot of people may be familiar with previous versions of products that were guaranteed universal life policies. Those were policies that were death benefit focused, and that would be the same for this type of design, but would have very small cash value accumulation within them. But as long as the client meets their premium obligation, they would be able to have that policy in place when they needed it. Well, now current versions of, and this has been the case for a little while, but continually evolving, there are protection index universal life policies that have guaranteed riders. And those policies guaranteed maturity, which in most cases is age 120 or 121. And they also still have the upside of an index. So if an index performs well over the years, they could potentially see additional growth on that death benefit if that policy performs really well over time. So not only would they have a guaranteed death benefit in place, but they could potentially also have an increased death benefit over time if that index performs well. So you've got kind of the best of both of those scenarios. In addition to death benefit, a lot of the newer carriers, or a lot of the products, or we would look to design a product potentially, if this was a concern, have living benefits associated with them. So scenarios where a policy would have a terminal, critical, or chronic illness. Chronic illness works a lot like a long-term care type design, where if a client can't perform 2 of the 6 activities of daily living, they would be able to enact or utilize a portion of their death benefit for a chronic illness event to help cover some of those costs associated with the care needed for that particular individual. So just want to make you aware of the flexibility of a protection IUL. You could have it with guarantees, you could have it without the fully guaranteed product. And in those cases, most of the time, the guaranteed column of the illustration on the ledger page is going to show till roughly life expectancies around age 85. We can look at products that have living benefits for chronic, critical, and terminal illness. So there's just a lot of flexibility associated with this type of product. Premium duration can also be adjusted as well. If you've got someone who doesn't want to pay for their entire lifetime, maybe they only want to pay on a policy until they retire. There's a lot of different ways to design these types of products. So the next case study we'll look at is related to what we would call supplemental retirement income. So this would be a scenario, an index universal life in this case as well, but this one would be an accumulation IUL policy. So we've got Ben, who's age 45, and Jen, who's age 42, married 18 years, have a couple of kids. They have college savings accounts to help the children if they choose to further their education. But when they established those accounts, they didn't start saving as well for their own retirement. They were really mainly focused on the kids' savings accounts. They are employed, both of them full time, and they have some employer sponsored 401ks, but you know, they weren't ramping those up initially when they first started out because of the college savings accounts that they put in place for the kids. They have approximately 20 years till they want to retire, and they're concerned about the amount of income that they would have once they do retire. So obviously, contributing to the 401ks is a great opportunity through the employer. If they do have some additional income or some additional funds that they could utilize, they could put that money into a accumulation IUL policy. Now in that design, the death benefit is less of a focus. It is more focused on the cash value. So generally speaking, the way that these types of policies would be designed is with a minimum face amount and a maximum accumulation desire. So we would generally work with a client, or we would work with an agent to say, how much are Ben and Jen willing to contribute on a monthly basis, an annual basis, so that they could accumulate the most cash value over those 20 years, keeping that death benefit low because the costs often associated with life insurance are related to the amount of death benefit in place. That death benefit would then grow over time. So let's say they were putting money into a policy for 20 years, we would design that policy for an increasing death benefit over those 20 years so that the death benefit did go up, but we're maximizing or optimizing that death benefit with whatever the amount is that they're contributing on a monthly or annual basis. The next design that we're looking at is titled the Daniels. They're 65 years old. They have a retirement income, a nice retirement income of $375,000 a year. They are self-insured in terms of they have a nice individual retirement account of 4.6 million combined. They've got some properties. Again, they've got a couple of kids here. So in this scenario, you might talk with the Daniels, or you're sitting down with them and they tell you all of this information, and you might think, gosh, they've got an IRA, they've got a nice healthy income. There's really nothing that I could do for them. Well, that's not necessarily true. Just because, as I was talking about earlier, someone may have this set up where it looks like they're really in a good spot financially, it doesn't necessarily mean that there isn't still a solution for them. So in this case, we'd look at a second to die, often known as a survivorship IUL policy for them. Um, the scenario that we looked at specifically to them cost them about $1,500 a month, provided them with $1 million death benefit. We could look at some scenarios that would build cash value over time. We could also look at scenarios, as I mentioned previously, there are second to die or survivorship policies that also have guarantees associated with them, where we could guarantee that to age 120 or 121. But the reason that we would look at this type of situation for them is they may want the life insurance to help pay out as a liquid asset, potentially covering their estate taxes and leaving the rest of those assets in place for their beneficiaries. So we were able to identify that they had some investment properties, being able to sell one of those properties or being able to liquidate other assets might be difficult for their beneficiaries to do if something were to happen to them. So having a life insurance policy as part of their, as another asset class could be very beneficial to them and to their clients, especially knowing that some of their other assets are tied up in things that are not liquid. So, um, even in a scenario where it looks like people have a certain number of things in place for them, there could potentially still be other solutions for them. And a second to die is another form of an index universal life. I did not add a question slide, but that is actually the end of my prepared remarks. So I will open it up if anyone has any specific questions. Jim, I don't know if mics are turned on or not, but we can address any questions if anyone has them.
Sure. Hey, Brad. Thank you very much. Yeah, we right now, guys, if you have questions, Brad went through a lot. Now's the time to type in questions. Want to talk really quick as I give you a couple minutes to type in questions and talk about a couple things. First of all, this is basically installment 2 of a 3-part series that we're doing on Universal Life. We did one last month that is available on our YouTube page, Western Marketing's YouTube page, or if you reach out, we are more than happy to email you the link to that. That one was more in general on IULs and why IULs, and not as case study driven, but a lot of really good different information on that. The last one in this series we're going to do near the end of March is on GULs, or guaranteed universal lives. So if you're either trying to just build your knowledge or new to life insurance or trying to add these products as part of your portfolio, please feel free. Let us know if you need that other link. This one will be emailed to everybody here, hopefully by tomorrow. And we'll go, we'll get it out to you as part of the follow-up email. But yeah, and the second thing I want to talk about is life insurance, as Brad alluded to, can be used for a lot of things. When I was younger, new to the business, life insurance was really just to protect, beneficiaries, loved ones, etc. when you die. Now, we're seeing IULs used for not just death benefits, which they can be used for and used very effectively, but also things like funding to supplement retirement income. We can do that very well with an IUL nowadays. So if you're an annuity agent, that's typically been looking at fixed annuities to supplement income, maybe talk to us and let's talk about, if maybe we should look at an IUL for your clients. Third and last, and then we'll get into, I see we do have a question, Brad, but is we just launched, actually Tuesday of this week, so 2 days ago, a new program that Western Marketing is involved with called the Stream platform. And what that does is I won't get too deep into it now, but it's about premium financing utilizing IUL. So if you have the right clients, what that can do is leverage a loan from a bank where no collateral, no personal guarantee, no credit check is needed, to get your client a much higher either retirement income supplement or death benefit. So if you have questions about that, let us know. We're happy to get you out that information, get you out that recorded webinar, answer any questions. It's going to be a really, really nice program. So let me get here to the question. Let's see here. So this one, Brad, is about the Daniel situation, and it says our agent Arthur has this situation right now. They're looking for distribution later, though, during retirement, say 75 to 90, and so I think Arthur, can you just let me know what your specific question is, or were you just saying that that's a real life scenario that you're running into for that? We want to make sure if there's a question, which this situation is, the one on our screen right now. Arthur, let me know if you have questions or we're just letting us know. Brad, there is a question from Tina, basically asking if we have any guarantee issue IULs out there.
So generally, when we're looking at a guaranteed issue product, those are small face amounts, usually 25,000 or less. There are no guaranteed issue index universal life policies at higher face amounts. There are some that you could potentially, or your client could potentially go through an accelerated underwriting program. For an individual or a second to die scenario, there would not be any guaranteed issue products that are available. If you start getting into working with executives at an organization, there are some company-owned life insurance programs, but we'd want to know exact scenarios, and we'd need to dive deeper into that. That would probably be a one-off scenario, but for an individual client or for a survivorship scenario for a situation like the Daniels or Jen and Ben and different things along those lines, there is not a guaranteed issue policy that's available out there.
Yeah, and Tina, just so you know, we do have, when Brad talks about under 25,000, that's typically final expense. At Western Marketing, we do have a couple really good GI or guarantee issue final expense carriers. For IULs, we have a different type. So what Brad was alluding to is almost like an express type of product. I know like Mutual of Omaha,
Yeah.
for example, has a really nice product they call IULE. So it's express underwriting. What that means in just basics is there's no APS, paramed, blood, urine, any of that. Basically, they do all the underwriting online based on the client information and the way the client answers the question. So it's an express underwriting, but it is not true guarantee issue, meaning that there's still criteria health-wise that the client has to qualify for. So hope that answered your question. If you guys, there's a few questions about getting more information or contracting. So really what I would suggest you do is just pick up the phone and give us a call. You're welcome to ask for me. My name again is Jim Codney, or if you're working with a marketer at our company, that's totally fine too. You can work with your marketer. Our number again is 800-852-7152. So you can just call and ask if you want to talk to somebody else on our life and annuity team. You would ask for either Amanda Johnson or Tyler Marr. They'd be happy to help you out as well. We have several different options in IULs, and one thing I want to stress about IULs or life insurance in general and annuities on what we do and how we do it when we work with you and you work with your clients is you can actually bring us information, right? We'll help you with what information we need, but you can bring us the information and we will help you design that case. And so if you have a client like the Daniels and you aren't sure what the best option is, give us a call. And again, that number is 1-800-852-7152. We'll help you design the case. And we do each case on its own merit. So we don't basically put, a square peg in a round hole, for lack of a better term. We pick the best product and carrier each time. So that's good. And then Brad, Arthur's follow-up question is, what's the best way to design an IUL in the case of the Daniels? One individual is 66, has plenty of money in a 401k and executive bonus plan. He's worried about long-term care late during retirement. What would you suggest? I think that's actually one that would be beneficial to the group, because I hear about stuff like this, especially concerns about long-term care. When people reach 70, the statistics are 65 or older, that 70% of people are going to need long-term care in their life. Brad, what would you do in a situation very similar to this, but LTC is the concern?
Yeah, great question. And I would say, no one scenario is going to fit, as you mentioned already. Each scenario we would look at differently. If they were in need of, or if long-term care was a concern, there's a few different ways that you can go. I mentioned the living benefits. There are carriers that have living benefits that are built in to a policy. Those policies, then you would have no cost for that living benefit. So the one that's typically used as a long-term care benefit I mentioned is the chronic illness. So if there's a chronic illness rider that's automatically built in, there's no cost associated with that plan unless they needed to enact it. So if they got to age 75, 80, 85, whatever it is, and they couldn't perform 2 of 6 activities of daily living, they're certified, they could tap into their chronic illness benefit on their policy, and there would be an administration charge, and there would be underwriting that would occur at that time. The alternative is that you could look at a policy that has a long-term care rider or a paid for chronic illness rider. In those scenarios, the client is then paying an additional amount for that rider, but there is an actual known benefit amount associated with it. So a lot of times it's 2% or 4% of the death benefit. So however that policy is designed, whatever that death benefit amount is, 2 or 4% of that. And it's a known specified benefit amount monthly that the clients would receive if they were to enact that rider. Same scenario with the 2 out of 6 activities of daily living. They're certified by a physician, and they would then be able to receive that known benefit amount, or they're still drawing down their death benefit the same as they would with the built-in chronic illness. It's just a matter of when the underwriting occurs. Does it occur up front with the rider, or does it occur on the back end with the built-in? So yeah, we could certainly look at what is the best solution, or what's the best fit for that particular client scenario. Do they want that known benefit and they're willing to pay for that rider, or are they comfortable with a built-in rider where there is no cost unless they would use it later on in the policy? Does that help?
Yeah, I think so, Brad. Arthur, what I would say is I would say give us a call and let's get the particulars on your scenario, the real things, not just it's like this case and basic ages, but give us the information and let us work up a case design for you. We're happy to do it, and we have, like Brad said, not only the critical or chronic illness, but we do have some products that really are built for specifically long-term care. So we can give you a couple different options for your client. And and again, I'm being asked for a number, so that's great. The number is 1-800-852-7152. Again, 800-852-7152. If you have any questions at all, folks, life insurance, whether it's final expense, IUL, something in between, if it's a buy-sell agreement, whatever you're working on for that, or annuities, the only annuities we really don't work with are annuities that require a securities license. So we do SPIAs, fixed index annuities. We do multi-year guarantee annuities, and annuities have been super hot still because of where the rates are. If you have a case and need help, just give us a call. That's what we're here for. That's our job. We're happy to do it. So with that, everyone, thank you so much for participating in the webinar. For those of you who asked questions, again, that's what we want. We want it to be conversational. So thank you very much for your additional participation in that. Again, our number to the office is 1-800-852-7152. My name is Jim Codney. I'm our National Sales Director. Brad, to you and everybody at Brokers International, thank you very much for your friendship and partnership, and hope everybody makes it a great day. Take care, everyone.
Thank you, Jim.
Bye-bye.
Appreciate it. Bye.